Everyone, welcome to Cup of Joe. I'm your host, Mike Carrazzo, the content manager here at Ryerson. As we like to call it, it's a coffee talk with a shot of commodity expertise, and that commodity expertise comes from my man over here, Nick Webb. Nick, how you doing?
Good afternoon, Mike. I'm doing great. Happy December.
Yeah, same to you. You're the director of risk management, commodities hedging, I should say. And you know, did you know that this is our 9th episode of Cup of Joe? We've done
Time
8.
flies when you're having fun. It's amazing.
Yeah. We've done, I thought it was interesting. I pulled a few numbers here. 8 episodes. We've done a little over 440 minutes worth of content. We've answered more than 80 questions on air. You've mentioned the shortage of everything roughly 200 times. Don't go back and count that. That was just a rough estimate. We've had 3 guests and 1 Nick Webb beard, which went away, and now it's back here.
It's back, but maybe for different reasons. We'll have to talk about that here in a little bit.
Yeah.
But man, 480 minutes. I'm a blabbermouth.
Well, no, I think that's what this means is, I think what's important here is, I mean, we've spent a lot of time on this content. You've spent an amazing amount of time on this content. We've been delivering it here since April, and that's the intent, is to educate a little bit more on what's going on in the marketplace. And I think that's what's going on here. I do apologize. I got a little frog in my throat here. I feel like I've been talking for 440 minutes. Nevertheless, we want to talk a little bit about what's to come in the next few months. I think it's we're going to continue this for sure in 2022 with a few different a few things going on. But I guess to kick things off first, in February, so we're going to get to January's show. January's show is going to be a little bit different, and Nick's going to get to that in a second. But the February show, we're going to debut some original research here. The Metal Perspective is our twice annual customer survey, where we send it out. We ask questions related to business conditions, macroeconomic conditions, all the things Nick talks about, just with a customer perspective on it. And we're going to be collecting results starting today, actually, and through December and through some of January, and debut some of those results in February. So along with the regular update, Nick's going to get into some of those numbers for the first time. So I'm very excited about that. And everybody here in attendance, anybody who's registered, you're going to get an email tomorrow morning with a link, and we'd love for you to take the survey. You'll get exclusive results. We'll make sure we send those to you as we publish them. And like I said, it'll be part of the February Cup of Joe. Now, didn't mean to skip over January. Nick, tell us what's going on in January.
Yes, we got a couple things in January. One is going to be the 2022 virtual conference for Engage. This is going to be on Thursday, January 20th, as you can see here. We've got a registration link here on the screen. Hopefully all of you are able to join us. This will be a little different than our Cup of Joes, and the primary reason for that is because, one, I won't be there, which I think will be a welcome surprise for many of you. You will get some expertise from a number of different types of participants, and this time I think it'll be really beneficial for a lot of you, where I give a lot of the commodity background and the specific market related data, whereas we oftentimes get questions about mill related content, supply demand dynamics. And you can see here, we've got a great slate of characters from the mill side of the equation: Nucor, North American Stainless, Arconic, and Nucor. So you'll have a great chance, hopefully, to ask some questions direct into the source of who's producing the material and driving the markets around. And then additionally, we'll have an expert on the economic side who will do a far better job of talking about the macroeconomic scene than I will. But I think it'll be a great piece of content. And correct me if I'm wrong, Mike, I think we're also going to do maybe a 3 to 5 minute piece of quick content, just to kind of make sure we're staying in contact with everybody on a monthly basis from the Cup of Joe standpoint.
That is correct. As you know, we do this the first Thursday of every month. So the first Thursday of January, it'll be kind of a short video message that we'll send out on Nick's behalf. We'll do, as Nick said, Engage later that month, and then back to our regularly scheduled Cup of Joe starting in February. So wanted to mention before you kick off, Nick, there's use your Q&A button there at the bottom to ask a question. We'll do our best to answer it throughout. And as always, the full recording will be available on YouTube starting tomorrow. So without further ado, I'll kick it over back to you, Nick.
Awesome, thank you. So real quick, housekeeping, safe harbor provision. These are the opinions of Nick Webb, Mike Carozzo, not the opinions of Ryerson. Do your own research. We're doing our best to provide the content that we can, but sometimes we get it wrong, sometimes we're off. But yeah, that's the primary aspect from the legal standpoint. Let's go ahead and hop into things. So we oftentimes talk about the ISM and PMI data. We talk about it in different fashions. This time I wanted to dive a little bit back into a deep dive into the ISM data. And the reason for that is because I think when you dive into some of the line items, you can get some pretty interesting intel. And I think it tells an interesting story within the United States manufacturing landscape. First and foremost, we've got a headline number of 61.1, which those who are keeping score, anything above 50 is suggestive of growth. 61.1 is a pretty strong number. So here in the United States, in Europe as well, we're seeing some pretty excellent strength within the manufacturing economy. So I think that's going to carry the momentum into 2022 in a fairly strong fashion. We have, and we'll have a slide on this, but China is kind of muddling along a little bit, kind of either side of 50. So it's having its own issues, primarily with regards to the property sector. But as we look just significantly within the, or specifically within the United States, things look pretty darn good. A couple interesting items I want to point out, however, one is from an inventory standpoint, kind of midway down, you'll see a figure of about 56.8. That is a figure that's kind of suggesting that inventories within the wholesale side of things, so think service centers, maybe further up the supply chain, are improving a little bit. And I think we'll have a couple slides and a couple pieces of evidence that are suggesting that at the wholesale level, some of these bottlenecks, some of these shortages are getting a little better. I think when you look at the end user side of things, which I've shown here, I've highlighted here with an asterisk, customer inventories, which is going to be more representative of sort of the downstream markets. You can see customer inventories are quite lean and getting worse. And from that vantage point, I think it's an interesting dynamic. And we put it in the context of the Federal Reserve and whether or not we should be tightening or being more accommodative. I think it's important to think about inflation of the context that within maybe the service center realm, things might be loosening up a little bit. But I think when we think about finished products, whether it's of tractors or cars or appliances, it might be getting worse. And from that vantage point, we could expect to see finished prices to end consumers continue to go up, despite the fact that we're actually seeing some things like carbon steel on the decline. We're even seeing it in a little bit in aluminum as well. So those are a couple of the key highlights. The other two that I really wanted to point out, because they do kind of directly relate to the Federal Reserve and whether or not they should be tightening or tapering, is going to be employment. We've talked about this in a number of months prior, but employment for the last 3 months is on a trend of improvement. So we're actually seeing employment numbers get better. They are creeping back down towards sort of pre-pandemic type figures. We're not quite there yet. I think a lot of that is coming by way of increased wages, which for the end employer, or sorry, the employee, a very good thing, and hopefully allows those employees to keep up with the rate of inflation. And then the other aspect is going to be similar, which is prices. Prices are still very much so on the rise, and they have eased back in terms of the strength of their growth, and we'll talk about a couple of the reasons why potentially that may be. But nonetheless, an 82 print on the ISM prices indice, that's strong. I mentioned it earlier. I still think even though we're seeing some softness at the wholesale level, I think the prices of finished goods, I think the prices of homes, rents, things like that are still very much so on the upswing. So when we think about the Fed has really a dual mandate, which is watch employment and watch inflation. And as we just talked about, both of them are really kind of fitting the mold that the Federal Reserve wants. And for that reason, we are back to talking about the tapering process. And I brought this slide up in months past, I think maybe last month specifically. The Federal Reserve is expected to continue tapering its asset purchases to the tune of about $15 billion every month until June of 2022. And that's really kind of taking the punch bowl away from the system and saying the economy can function on its own. That's really the general belief. And then once that tapering is done, maybe then they can start discussing whether or not they want to increase interest rates and maybe try and use some of their tools to cool this inflation. Now, there's a lot to take in here on the macro side. I'm not a Federal Reserve expert. I don't pretend to be, but there was a very important headline that took place last week, right before Thanksgiving, which was the JPAL actually came out and mentioned, actually it might have been earlier this week, JPAL came out and mentioned that there is a possibility and there will be discussions about the idea of speeding up the taper process. And if anybody's watched any of the markets over the last couple of days, it's really kind of jolted the markets in a pretty volatile fashion, because I think the concern in the market is, oh shoot, well, if they speed up the taper, that's going to take away some of the fuel that we've had that's fueled things like commodity prices, like equity prices, and ultimately kept interest rates low as well. So that's something we certainly want to keep an eye on, whether or not, if inflation data in the next couple of months prints higher than expected, we could see the Federal Reserve speed up the rate at which they taper asset purchases. So again, something to keep an eye on. I'm not an expert in this field, but it is certainly something that has the ability to move markets across the board.
Hey, Nick, how does this relate to the continued strength of the dollar and any correlation with commodity prices?
Yeah, I would say very much so. There's kind of a linear connection between all of those assets. So if there's an expectation that tapering is going to occur and maybe eventually interest rates are going to rise, typically that has a strengthening effect to the price of the US dollar. And as we've talked about in prior months, if the dollar is strengthening, all things being equal, it tends to be a headwind to the price of commodities. So they're all very much so linked together. And also, I mean, I think generally when you think about risk assets and things like that, if somebody's out there with a blank check just purchasing everything under the sun, that's ultimately going to be rising tide lifts all boats for assets in a very direct fashion as well. So we talked about this chart for a number of months. It continues to play out in a similar way in which I think we would have expected, which is as the Chinese credit impulse data continues to print weaker and weaker. Basically, they haven't yet utilized their stimulus mechanism within China. There are a number of analysts, there are a number of experts out there that think that they may be holding off until post-Olympics, that they kind of want to keep pollution down, they want to keep growth kind of abated for now, and then maybe once the Olympics are gone, it's full throttle, pollute, manufacture everything, and throw a bunch of money into the economy. We'll have to see how that plays out. If that is how it plays out, I think that would be certainly a bullish scenario for asset prices and commodities alike. But for now, you can see that if we assume this relationship to hold up, which is credit impulse data, which means lending activity, credit activity in the Chinese system is still on the decline, we would expect that to be a headwind to the price of commodities. And I'll touch very briefly on this because I think it's an important subject. The property sector within China continues to kind of trough along a bit. And there have been some interesting headlines where, like, the CEO of Evergrande, he posted a number of his mansions as collateral. He's gone out and taken personal loans so that he can personally guarantee a lot of these loans. So we're not yet through fully to the other side of these credit issues with regards to their property developers. It's not to say that it can't get fixed or that, a massive wave of stimulus can't fix some of these things, but I think there's still probably going to be more to the story here in the coming months. We've talked about this slide in last month, and I think the month prior to that. This is only a 5-year chart. We last had this on an all-time basis, but this is a 5-year chart of the Bloomberg Commodities Spot Index. So it's looking at a basket of commodities across energy products, precious metals, industrial metals, and agricultural products. And you can see here that, that print that would have happened a couple weeks ago, that was the all-time high on the commodity benchmark. So when we think about, the fact that the Federal Reserve finally came out just in the last week and finally killed this idea of transitory inflation, it's kind of a shocker that it took them so long to do so, because, as Mike had mentioned, we've done about 9 cup of joes now. And I'd say probably for the entirety of those 9 cup of joes, we've been talking about pretty rampant inflation within the industrial metals sector. Now, the industrial metals sector are not the only indicator for inflation, but if we use that as a proxy, certainly we've seen inflation in a massive, massive way within commodities and specifically within metals. But you can see just in the last couple of weeks, it has retreated a bit. I would say the main reason for that is not necessarily because of industrial metals, although we have seen a little bit of easing. The bigger factor here, and this is a little bit of the issue with this index, is it's pretty heavily weighted towards energy commodities, so crude oil and natural gas. And as many of you have probably seen, in the last basically 3 weeks, we've pulled about 25% out of crude oil, and I'd say probably 30% out of natural gas prices. And we'll talk about that in more detail. But we're still at very elevated levels. There's no doubt about it. You can see it very clearly here within this chart. Additionally, when we look specifically at the industrial metals prices, this is using copper as a proxy for industrial metals. And oftentimes, I think we've talked about this before, copper gets the nickname Dr. Copper because it has a PhD in economics. Essentially, the idea is copper goes into a lot of things that are manufacturing and economic related. So where copper goes, so too could you assume the general economy can go. It's not a perfect gauge, but it's something that economists like to joke around about. And you can see that I've drawn in the moving average lines. So here are these, the yellow, the green, and the purple line. Those are indicators of momentum. So a lot of traders watch these to try and determine subsequent direction in prices. And you can see that there's been a convergence in all the moving averages. And right now we are seeing copper prices very much so testing all of those moving averages. So we're kind of at a crossroads right now. And when we take a step back and we think about all the things that are going on in the economy, you know, we've got a new variant that's catching a lot of headlines. We've got, you know, central banks that are trying to figure out whether or not they want to be hawkish or dovish in the face of, you know, potentially new variant. And you know, risk assets are responding in both directions. They're very choppy markets right now, both in commodities as well as equities and fixed income markets. And I think we can probably use copper eventually as a gauge for, you know, if this thing rolls over and breaks below a lot of these moving averages in a meaningful way, it might mean that we're going to see some risk off in a lot of other asset classes. But if the Fed ultimately steps back and says, okay, we don't want to spook markets too much, we're not going to speed up the tapering process, then we could see prices maintain and even go higher from here. If you sprinkle in this notion that maybe post Olympics, post February, China comes in and adds a bunch of stimulus to the economy, I would say almost undoubtedly that would be seen as a bullish indicator for commodities and risk assets in general. So, you know, I'm not here to try and predict what's going to happen, although I do attempt to on occasion. But we are very much so at kind of a crossroads within which direction we ultimately go from here, because we've had a heck of a run in prices of all things over the last 18 months. Now, talking specifically about the energy side of things, I won't spend too much time on this, but this is a very fluid situation as we sit here today. Just over the last 2 days, we've had OPEC Plus meeting where they've been discussing whether or not they want to pause their production increases or stick to the previous script, which was to increase production by 400,000 barrels. They did, surprisingly, or at least to my surprise, they did stick to their guns of saying that they are going to increase crude oil production. Interestingly enough, you know, a lot of the takes that I've seen on that is that some of that may be for political reasons. They're not trying to upset the apple cart too much with regards to Russia, which Russia is very much so on board with wanting to push more crude oil out the door. They don't want to upset the United States, who's been calling for the last 2 or 3 months on OPEC to increase production. But it's interesting because I think, you know, if you dig deeper into the headlines, OPEC did also say, well, we very much so have at the drop of a hat, if we want to, if we see that the Omicron variant is having a bigger impact on international travel, mobility, and demand of energy, then we can very, very easily turn off these production increases. I think the other aspect that's actually seen in kind of a perverse way as being bullish longer term is, you know, we've seen 25% come out of the price of crude oil. here we have a lot of United States energy producers who are probably looking at this market saying, uh-oh, as we think about 2022 budgets and how we're going to spend money and whether or not we're going to contemplate investing more money into additional drilling, well, they're probably rethinking those plans quite a bit right now, which I know that's kind of bullish, bearish, but I think longer term, I think that's being viewed in a somewhat supportive light because it probably does keep a lot of those long-term investment projects into fossil fuels at bay. And there may be many who, particularly on the green movement side, who would say that's a good thing. We don't want more production. But I think as we've talked about in prior months, supply demand conditions in fossil fuels right now are pretty darn tight. And this is a very sensitive topic. And I don't want to be too hyperbolic with these comments that are coming up. But if you look at a lot of bank analysts right now, Goldman Sachs has basically an $80 to $90 price target on crude oil. Bank of America is a $125 price target on oil. JP Morgan and Jefferies just recently this week came out with a $150 price target on crude oil. Now, some of these may be headline grabbers. They may be to try and get a little bit of attention or spook fears within the marketplace. But there is a real risk that, and we've talked about this before, if global energy markets have issues with getting intermittent supply of wind energy, solar energy, hydro energy, there is still, as we transition towards this green future, there is still for the next at least several years, if not decades, a reliance on fossil fuels as that baseline energy source. And given the fact that we've got a lack of investment, and some of that's been purposeful, given the fact that we've had a lack of investment in a lot of these spaces, there is an upside risk premium that exists within these markets that we could see in a worst case scenario. We could see 3-figure crude oil again. So again, I'm not trying to pander to all the bank analysts and say they're absolutely right, but I am saying I think there might be more to the story than just what we're seeing as we sit here today in early December. Because a lot of the analysts that I'm reading are saying, yeah, we're seeing a pullback, but this seems like an interesting opportunity to actually layer in some long positions or some hedges if you're a consumer. That is, again, not a recommendation, but it is at least what the analysts are saying.
Nick, correct me if I'm wrong, but you mentioned about the possibility of, as you the energy producers looking to next year, maybe slow drilling, slow production. That has an impact on supply too, right? Or demand, I should say, because the energy in making those drills, the drilling equipment relies heavily on various carbon steel, right?
Yeah, sure. And I mean, we're not here to talk solely energy markets, but as we think about its relationship to demand and we think about its relationship to metals markets, by all means, certainly if CapEx projects go to the sidelines because crude oil and natural gas have gotten slammed in the last couple of weeks, that would be incrementally a negative for a number of metals markets on the demand side. It may not be massive, but it certainly would dampen those demand indicators ever so slightly. But yeah, I think the bigger thing is just that, and I'm not trying to get too political, but there's very much so been a message from administrations of, and whether you're looking at the climate meeting that took place several weeks ago, or you just look at the headlines of the current administration, the interest is not currently to tell U.S. producers to produce more. It's really trying to encourage the increased production to occur within OPEC. So OPEC's kind of in the driver's seat right now. And I mean, if I'm a U.S. energy producer right now or North American energy producer right now, I'm probably feeling pretty hurt. I'm probably feeling like I'm not all that enthused about throwing a bunch of money into this thing. So that's going to potentially keep the structural deficits in place longer than we may otherwise want. So it's just one of those interesting things as we try and push more towards a greener and greener future. My personal opinion is we shouldn't fully forget about the transitionary need for some of these fossil fuels, because if we forget about them too much and demand remains strong, or God forbid, if the entire world reopens, which we have not seen a world reopening in the last 2 years, Jefferies, the analyst at Jefferies basically said, if we see a global reopening, he thinks we see $150 crude oil. Now, that is a big if, because if you can tell me when the globe reopens, I think you have a very big leg up on understanding where risk assets are going to go and when they go.
Good point.
Lastly, and this is still on the energy side, even though we've seen United States markets within crude oil and natural gas come back quite a bit in the last couple of weeks, this is just to reiterate the point of, I don't think we're fully through the sensitivities of the fossil fuel and the global energy issues. Because this again is a chart of the European natural gas price. And again, natural gas versus crude oil, they're all somewhat interrelated, and this is a little specific, but this just heightens, or this just, sheds a light on how sensitive these markets can be to just slight deviations in supply demand dynamics. We, for a couple of weeks, thought that natural gas prices in Europe were going to start crashing back down the way they have in the United States. Well, they're getting some colder temperatures, and the Nord Stream pipeline coming out of Russia has not yet opened up. There's still sanctions on that. That has not been approved. And until that gets approved, I think there are some real risks within the European supply chains with regards to energy. So tying that back to metals markets, if we were to see crude oil, natural gas prices worldwide perk back up and do kind of what we're seeing within Europe, a lot of those risks that we've talked about in prior months with regards to magnesium, with regards to silicon, those can come back pretty darn quickly. We're not seeing them just yet, but I just want to throw that out there that I don't think that risk is fully off the table just yet.
Hey, Nick, question here from the audience. Right, I know you don't want to spend too much more time on energy, but audience wants you here. Do you expect the US dollar to increase in value as OPEC increases production?
I mean, I'll be honest, I don't have a great answer to that. I think the US dollar is going to be more so pegged to what the Federal Reserve is going to do. So if we speed up asset purchases and quickly hop into a rate hike cycle, that would be bullish for the US dollar. That would be bearish for a lot of risk assets, all things being equal. I don't think it necessarily has to have direct linkages to what OPEC does or doesn't do.
Sounds good.
And lastly, again, I'm not an expert in the freight market. I did want to touch on this because it caught some headlines over the last couple of weeks, which was the headlines were suggesting that a lot of the queues at the ports, basically the number of ships sitting at port, specifically with regards to the Southern California ports, a lot of the headlines were suggesting that big corporations were seeing those queues drop significantly, and that it was going to be bullish for opening up the supply chains. Well, I came across this chart just a couple of days ago. It came from a company called FreightWaves, and their suggestion was that really the backlogs at the ports haven't actually changed all that much. What's changed is the way in which we're reporting how many ships are there. And I won't go into too much detail, but I thought it was interesting because Walmart came out and said, oh yeah, the bottlenecks look like they're getting a whole lot better. These guys are kind of coming out and saying, the reason why it looks like it's getting better is because the ships sitting within 40 miles of the port are decreasing, basically the ships that are anchored. But what they're doing is they're having a lot more ships basically sit afloat more than 40 miles off the horizon, so they can't even be seen by shore. And I know this gets a little conspiratorial, but I thought it was interesting. I thought it was something that would be worth sharing because, depending on what you read, some are suggesting that the port issues are getting a whole lot better. Some are saying they might actually be getting a little bit worse. And I think as we head into Christmas season, and shipping is going to be a very important thing. There may be some difficulties ahead still with regards to a lot of these logistical networks.
Well, it's the positioning of the rig is what you're saying.
Of the actual ship itself.
Absolutely. Yep. Wow. Okay. Very interesting.
Which as a callback to Jeff Penn's, who we had on a couple calls ago, he was mentioning the fact that there are companies that actually track the mapping of all of these ships. I might actually have to spend a couple days to dive into that data and see if we can actually verify on a map where those ships are sitting, or see if they've actually shifted more out to sea. But interesting data point nonetheless. And if there are questions about it, we can certainly talk about it more. But with that said, we'll dive into the metals markets here. So first things first, I would say more so than any of the other metals we're looking at, nickel prices, and again, you'll see the moving average lines as an indicator of momentum. Nickel more so than any of the other markets we're watching right now. looks like it's got some momentum behind it. You can see it's currently trading above its 50-day, 100-day, and 200-day moving averages. It's not necessarily in a new price range. We're still right around $9, which we've been at for a number of months, but it hasn't broken down the way we've seen aluminum markets break down in the last 2 months, and carbon markets even more so in the last 2 months, I'd say. So nickel markets look pretty well supported. And one of the main reasons for that is because exchange inventories are at pretty darn lean levels. We're not quite back down to those scary levels that we saw back in late 2019 when there were real concerns that we were going to run out of nickel units. But we're not too far from that level either. And Goldman Sachs, they've been putting out a number of headlines in the last couple of weeks and months, which centers around this idea that if we continue to see demand creeping up on a global basis, and we continue to see a push towards, green energy movement, which includes things like electric vehicles, there could be some real supply demand issues on a longer term basis, maybe multi-years looking out into the future, with regards to getting available nickel units. So it's gotten lean in a very quick fashion over the course of 2021. And I think a lot of traders are watching the trajectory of these inventory levels at the exchanges as a gauge for whether or not they should kind of hit the panic button on nickel. I don't think we're quite there just yet, because I still think we've got a relatively balanced supply demand market globally. But if we kind of like crude oil, if we see a global reopening, there are some real structural risks that exist, not just within crude oil, not just within nickel, but I think in a lot of markets like copper and aluminum as well. It feels like almost every month we have a chart where it just looks like it's taken off and gone parabolic and ignored everything else. And this month's kind of soup du jour is silicon prices. And silicon, as many of you may know, it's going to be specifically going into silicon wafers, which goes into semiconductors. So as semiconductor demand, both from the tech industry as well as from the auto industry, ramps up, which I think it has over the last couple of years, that's going to create a demand squeeze. But in addition to that, what it does do is silicon does go into, it's an alloy, it's an item that goes into stainless steel, it goes into aluminum, it goes into carbon steel. So pretty much all the metals that Ryerson touches in a big way, silicon does to some degree go into that, and prices are taking off. So for now, what I would expect is we're probably going to see surcharges increase just by way of the silicon factor going into a lot of the stainless steel surcharges. It's even possible that we could see surcharges coming from aluminum producers or carbon producers where they say, well, we've got to figure out a way to pass this through. They're not just going to eat it typically. So it's kind of the next thing we got to worry about, which we hadn't been worrying about before, is silicon. One caveat I would make to the silicon market being wildly strong, and this might be anecdotal, but just in the last 24 hours, Apple did hit the headlines coming out saying that Apple notified their suppliers, indicating that iPhone demand for the holiday season is a little weaker than they expected. Their stock is getting hit a little bit, but the reason why I bring that up is because obviously semiconductors have a lot of silicon. Semiconductors are in a big way are going into iPhones. So if Apple is seeing decreased demand for iPhones, there's a potential that may help to loosen things up within the silicon market. There's a chance that it may also help to loosen up the semiconductor market for the automotive industry, which I think would be incrementally bullish for steel prices.
So Nick, with all this, does it affect the import price, say, of like stainless steel sheet coming in from China, right? Would that mean why it might be coming in at a higher rate?
Yeah, maybe not immediately, but I mean, if as you can see in the chart, these moves that are kind of going parabolic are very recent. So if they're happening now, we may expect that to hit, the stainless import prices 3, 4, 5 months down the road. So yeah, there typically would be a lag effect, but yeah, I would, whether you're making stainless in China or you're making stainless in the United States, it's going to be impacted by silicon markets. We may have a frozen Mike Carrazzo. Hopefully it's not on my end.
Nope.
You're just good at staying still.
I just hold that. I just hold that look very well.
Perfect. Well, hey, let's hop over to the carbon side of things, where it's a continuation of the theme we've been talking about for a number of months, but we are seeing a pretty differentiated landscape within North America. What I mean by that is the spreads when we look at U.S. prices to Europe or U.S. prices to China, they're still wide enough to drive a Mack truck through, but U.S. prices are very much so on the decline. The CRU this week came out on a hot roll basis, came down $65 just on a week over week basis. So pretty swift moves. I think a lot of this we've been expecting. Obviously, we've been at record highs and extreme record highs at that. So there was a situation where what goes up must come down. The question now is, at what pace do we come down, and where do we bottom out? We've got a couple things we can talk about with regards to that. But it's pretty wild. I mean, when you look at the global markets or the foreign markets rather, the U.S. market is coming down, but so too are the foreign markets. So when we think about import availability, we think about import arbitrage, it's still there. I mean, the gaps between foreign numbers and domestic are still definitely there. And while we can't buy Chinese direct because of the tariffs, Chinese prices over the last 2 months have dropped by $150 to $200. That's meaningful. And it's, again, we can't buy it direct, but China's 50 to 60% of the world's carbon production and carbon market. So they are kind of, they're at least something we got to have as a gauge for where things are. And they're currently pricing $676 on a local basis. So that's a bit off from where we are right now, which is in excess of $1,600 basis the CRU.
Nick, you mentioned, sorry, it's hard to predict the pace or the price. Does one create a little bit more uncertainty than the other? Meaning, like, do you keep more of an eye on, okay, it could go to this price, but I'm looking at the pace at which it goes to? I guess is one of those cause more uncertainty than the other?
I mean, being transparent, we as Ryerson, we carry a lot of inventory and carbon products, and our preference is ultimately that if we bought steel last month, and this is Ryerson specific, if we bought steel last month, obviously we don't want the move in the following month to be too swift to the downside. Otherwise, what we just bought is all of a sudden underwater. And I don't think that's any secret how Ryerson or any service center's business works. But so selfishly for Ryerson, I think the speed is certainly something I try and keep an eye on, and something I try and protect against, and we try and have very, very strong intel on that. And but with regard, longer term, I think there are going to be a lot of questions for service centers, mills, and customers, which is, where does this thing land? Are we going to see prices bottom out at $1,400, $1,000, or $700? And there are analysts across the board who are calling for all three. I can give some thoughts on why I don't think we're going to $700 immediately, at least given what we know right now. But something with a 1,000 handle or just above it in the not too distant future, it wouldn't totally shock me. I don't think we're going straight there, but and we'll have a slide on this, but scrap markets are still trading right around 600 to 650 per metric ton. So if we normalize markets and we assume some sort of mean reversion, a scrap plus 300 or 400 type number does put us around $1,000 on a longer term basis. So is that where we settle? It could be. But I will say, I handle a lot of our customer hedges, and we see a lot of customer hedge activity, and we hear anecdotes of other customers who are locking up 2022 pricing, $1,300, $1,400 for hot roll for next year, and doing it fairly happily. So, I don't think the prices are totally scaring the consumer side of things in excess of $1,000, and that gives me a little bit of confidence that maybe this thing doesn't just totally crash out. But that being said, we look at the futures markets right here. We're looking at it a month ago in the green line. The blue line is going to be current. The market was expecting a fairly steep trajectory to the downside. that has sped up ultimately. That trajectory has sped up, and that's indicated by the fact that the blue line is ultimately lower than the green line. That just suggests that the expectation now is incrementally lower than where we would have been a month ago. I think we can probably attribute that to the fact that, one, obviously the CRU has sped up its moves a little bit on a weekly basis. I think the fact that tariffs have opened up a little bit of incremental supply, or perhaps cheapened up some of that import supply, I think that's a factor. And then, I think the variant news and the tightening news from the Fed also play a factor, as does crude oil markets. I mean, I know we spent a little bit of time on energy, and some may be saying, why are we talking so much about energy? But energy is going to have linkages to all things, and these, a lot of commodities are watching crude oil as a proxy for where they ultimately land. So I think all of those factors, whether it's oil, the Fed, the variant, and property weakness in China, all of those things have incrementally fed into a slightly weaker U.S. price. But again, you look at the long-term back end of this chart, even back into 2023, the market is currently pegging things right around $900 for the longer-term price at which we might land. Is that going to be right? I have no clue, but I think that the market is probably following the same logic that I just walked through, which is if you're looking at it from an electric arc furnace standpoint, if scrap is 600 to 650, you want to make 250 to $300. That probably puts the back end of, probably puts the fair value in a normal, well-supplied market somewhere right around there. The caveat that I will say to that we've had some discussions on internally is if markets end up getting too cool, meaning they drop too far too fast, and I don't know if any of the mill executives are watching, but there's a chance that we have a very consolidated, we do in fact have a more consolidated steel industry now. There's a chance you might see maintenance take place where a mill will announce a maintenance outage and they'll take some of the supply offline to better balance supply demand conditions and stop the fall. I wouldn't put it past the industry to do, and that's not to say that it's wrong or to put them in a bad light. That's not at all what I'm trying to do, but I think it would make fundamental sense from a supply demand balance standpoint if they're trying to stop the fall. And lastly, this is a new chart for us, but it's one that I think we certainly want to be cognizant of, which is the fact that if you're buying hot roll versus cold roll versus galvanized or even plate products, the pricing dynamics are pretty different right now. And what I mean specifically by that is it doesn't look like much, but over on the right-hand side, you can see that the price between the hot roll coil index and the cold roll coil index has blown out pretty massively in a rapid way, basically since October. You can see basically essentially a two-year average right around $200 is the normal spread over this time period. Longer term, I would say the spread is typically 110 to 130. We have gone now to close to about 430, 435 is that current spread between hot roll prices and cold roll prices. So what does that mean? That means that if you're a buyer of cold rolled, you're not quite seeing the price declines that we've been talking about thus far. Cold rolled on a relative basis has actually held up pretty darn well. And what that's done is it's caused the spread between the pricing on cold rolled and the pricing on hot rolled to blow out massively. Now, why would that happen? I think a couple of reasons, and I've had some discussions internally on this as well. One reason is it sounds like the capacity for mills to re-roll hot roll steel, to run it back through a cold rolling process, capacity is pretty tight right now. So if we looked at this market, if I were a steel mill executive and I had excess capacity to run steel back through a re-rolling facility, I'd be doing it all day long. I would be looking at any tons of hot roll coil that I had. I would say, let's not put it out in the market. Let's rerun it back through our facility, roll it back through, cold roll it, and collect that spread. Because right now they can probably make an extra $300 to $350 by doing so. The question is, can they? I don't have great intel. I'm obviously not running a mill, but the intel is suggesting that ability is fairly constrained right now. But you can bet every mill executive right now is looking at this chart saying, why in the world are we selling hot roll when hot roll prices are coming down rapidly and lead times are coming down rapidly? Which it's worth noting, lead times on hot roll are like 3 to 4 weeks right now, which is really, really short, meaning there's an abundance of availability, or you can get hot roll pretty quickly. Cold roll is a different story. So, if you're a mill executive, you're probably trying to run 24 hours a day, running hot roll back through your facility and selling it out in the market as a higher value added product. So for that reason, and this is a little forward looking, this is just kind of a thought. If that is how it plays out, I would expect this spread between hot roll and cold roll prices to eventually come back down in the coming months, just because it's a pretty unique opportunity for a steel mill to kind of arbitrage their own business. But the bad news for those who are buying value-added product is you're not quite seeing the price declines that we're seeing currently within hot roll. I think in addition to that, there might be an element of the fact that, crude oil markets have come off fairly hard recently. Hot roll tends to be more related to those markets, whereas cold roll is going to be more related to the automotive market. There are some headlines coming out that automotive is perking up a little bit, that semiconductors are becoming a little more available. So that could explain a little bit of the demand side of the equation as to why cold roll is holding up a little better than hot roll. And we've talked about this anecdotally, but here's the chart of it, which is showing busheling scrap is actually holding up pretty darn well, right around $600. But as we've discussed in prior months, the price of scrap really does not matter to steel right now, even though we keep talking about it as a potential to where steel prices ultimately go. Right now, the spread between scrap and steel is still $1,000, which is way, way in excess of what it normally is. So scrap is holding up, and that may be something that steel mills may point to say why steel prices shouldn't fall too far, but the gap is still quite wide. When we look at iron ore markets, which is maybe a better gauge of Chinese prices, and I think maybe is a reason why we saw the Chinese price here in this chart drop over the last couple months, the price of iron ore has gotten absolutely slaughtered. And that's on the back of what we talked about earlier, which is the property sector within China is pretty weak right now. There are some real credit issues, real debt concerns. And with that, property developers are buying less steel, and steel mills are producing less steel, which means less demand for iron ore. So this is sort of a chart showing weakness in China versus relative strength within the United States, if anything. And then lastly, we'll touch on aluminum markets. We didn't talk about the fact that aluminum has pulled back from its highs that we saw last month, which was really kind of tied to the magnesium shortages, the energy crisis, both within Europe and Asia. But when we look at the moving averages, we have found a little bit of price support right in the $1.15 to $1.20 range for the LME price. So it's not fully rolling over. I think there still looks to be a little bit of support here. And as I mentioned, aluminum is another one of those products, or one of those markets that has pretty darn lean inventories. These are the exchange inventories at the London Metal Exchange. Now, again, I know that there are inventories that exist off of the exchange, but just as a proxy for how loose or how tight a market is, we oftentimes look at the exchange inventories as a proxy of that. And as we look at it today, we're at 5-year lows. So again, whether it's crude oil, copper, nickel, aluminum, if we really see demand come back in a big, big way, and if China flips on the spigot of stimulus, these markets are pretty lean already, and they're going to be sensitive to those types of fluctuations on the demand side. So, I don't think it's any secret as to why Jay Powell just this week retired the phrase transitory, because I think there are some real spooky scenarios that if demand came on in a big, big way, and the investment on the supply side doesn't occur in the next 6 to 12 months, these markets can get tight. Now, I don't know exactly how they play out. Again, if you had the answer to how global markets react to the COVID variants, you should be in a different job. But those are the risks. Those are the things we're watching. And it could get quite bullish for those markets in a fairly quick way as we look forward to 2022 and 2023. And then, similar to sort of the natural gas situation within Europe, magnesium's, again, one of those markets that kind of won't quit a little bit. It does look a lot like the aluminum chart where it's fallen off and then rebounded a little bit. I think magnesium still is kind of watching these energy issues and saying, well, we've retraced quite a bit from the highs, but we're not quite out of the woods yet. And again, I think if you overlaid the moving average lines, which would be your gauge of momentum, they would be suggestive that momentum is still kind of constructive or supportive of prices. So again, I'm not trying to stoke the fans of fear or the flames of fear, but I do think there are still some real risks on the magnesium front. They've abated for now, and it's kind of all clear as we look forward to the next couple months. But those things can come back in a quick fashion. So we got to keep our eyes on those things. And that's sort of, I know I gave an intro a couple of days ago to what we were going to be discussing. I expect a lot of volatility in the coming months, and it's going to cut in both directions. And I think as you've looked at a lot of these charts and a lot of these markets, they're going in different directions depending on where you are, whether you're at the wholesale level or the end customer level. But things are starting to get pretty choppy, and markets are getting more and more sensitive to supply demand dynamics, not less. So I think we got a fun ride ahead of us for 2022 and 2023. And then lastly, I know I've been jabbering on quite a bit. Want to leave you with a little bit of good news on the consumption side, which is Midwest premiums on the aluminum side have come off to the tune of about 2 or 3 cents. And we've talked about this in months prior, but I think that's on the back of a little bit due to the tariffs getting renegotiated for Europe, and it looks like probably for UK and probably for Japan. But in addition to that, the Russian export taxes are expected to roll off here in the next month. So those things should help to loosen up availability a little bit of aluminum ingot. And with that, we're seeing lower moves in the price of Midwest premiums as it relates to aluminum ingot. So I talked far too much. Hopefully there are a couple questions, but that's what I got.
Yeah, you were on a roll there. I didn't want to interrupt you. Great stuff.
I blacked out for a second. I'm sorry.
Great stuff as always. We do have some questions here from the audience. We have a few that relate to back to the carbon, the prices that you showed earlier, talking specifically on the coil. The questions are, is there any news on the HR carbon plate costs and supplies? So specifically, any news on the price or availability of carbon plate at this point?
Yeah, so from a pricing standpoint, prices are actually going the opposite direction for now of where coil prices are going. Now, I think mills are doing their best to try and get a more normal market. When I say normal market, historically plate has traded at a premium to hot roll coil, and I think they're trying to reinforce that argument. So I think they're trying to get things back into balance a little bit. So for now, they're sort of going opposite directions where plate prices are flat to higher. There was even a plate price increase in the last 2 weeks. So, but that being said, I think we've talked about this in months past, but plate prices tend to lag coil prices to the tune of 2 or 3 months. So I think we're maybe just seeing what we saw in coil prices from 2 months ago playing out within carbon markets. So it may be, I mean, we'll see how it goes, but it looks like it's just a different time frame of the cycle, if you will, for plate prices. So they're still on the upswing, whereas coil markets have already started to roll over a little bit.
Sounds good. Yeah. Staying on the carbon pricing, do you believe that carbon pricing is a leading indicator for stainless prices that may be lagging behind the broader pricing downturn?
I don't. I think, there's going to be some overlay. Obviously, if demand for carbon steel is high, that should be a general indication that demand for all things industrial product related is high as well. I think you can generally make that really broad, high level assumption. But I think when you peel back the onion, you look at the actual supply demand dynamics of them and the pricing dynamics of them, I don't think we can make a lot of comparables at this point. And the reason, specifically what I'm talking about is, carbon prices went up 400 to 500% over the last 18 months. Stainless steel prices and nickel prices didn't do that. So they just got themselves into different territory. And I think for carbon, we've been calling it wrongly, I'll throw myself under the bus. I've been calling for carbon prices to fade off for almost 12 months now. and they were much more resilient than I thought. But I think it was only a matter of time until things reverted back to truer fundamentals. And mills have gotten caught up, obviously, with hot roll lead times down 3 to 4 weeks. It's very clear that supply has caught back up, at least on the hot roll side. Whereas I think on the stainless side, the backlogs and the consolidation, and even some of the raw ingredients create a different pricing dynamic and market dynamic for stainless steel than what we see within carbon. Over a longer period of time, multi-year, yeah, I think you could probably make some relationships, but over the next 6 months, I don't think they're going to be similar markets at all. I think stainless looks, on a relative basis, still quite strong.
Sorry, I had a little delay there. How about got time for a few quick questions here, and if we don't get to your question, we can follow up afterwards. They're starting to flood in here. So a good here, it speaks to aluminum. How big of a concern is the future supply of aluminum with the low supply and mega trends of lightweighting and electrification?
It's real. I would say it's real. And I know I mentioned the Goldman piece, and not that Goldman is the end all be all on where commodity markets go, but I think their general thesis is fair, which is if the trend is going to be more towards lightweighting and green energy and CAFE standards and things like that, aluminum and nickel and a lot of rare earths fit in that mold pretty spectacularly. And unfortunately, as we sit here today, as we talked about, on this slide here, inventories aren't exactly robust on the ingot side, at least. And now that being said, I want to caveat all of this by saying just in the last week, there was an announcement for a pretty major investment into an Indonesia aluminum smelter. And I believe the tonnage was 2 million tons per annum, that's really big. I think that's almost half of what Russia produces in a year. So it's a meaningful project, and that would be the type of headline that we need to see if we're going to be real on a global basis about moving towards a green energy future. Because if those investments aren't taking place, there isn't enough metal out there, whether it's cobalt, lithium, aluminum, copper, nickel, I mean, you name it. There are a lot of markets in these spaces that are going to have structural issues if we truly go towards that future in a quick fashion. So yeah, I think the question is sound. I think it is a real hurdle that we're going to be dealing with for years to come. And it's going to take some pretty major investments like that one in Indonesia, which might help ease the upside risks in prices and availability. But we're going to have to see more of it probably.
And we got time for one more here before we wrap up. What is the future? You talked last month a little bit on the zinc increases and its effect on galvanized products. Any update there?
Yeah, it's faded back a bit. It looks a little bit like the magnesium chart and looks a little like the aluminum chart. And I apologize, I didn't include it in this chart. It's mainly just because it's kind of cooled off and faded a bit. So for now, it looks like a lot of these other markets. So, but that being said, I mean, Glencore did cut production. So they're actively taking steps to keep that market structurally tighter. But for now, it's reverted back lower. But the chart looks very similar to the aluminum market and the magnesium market, which is kind of that notion of, yeah, it's pulled back from the highs, but it's still kind of got some support.
I lied. One last question. This one came in like right away. They want to know, with the reappearance of the facial hair, is there a market reason behind that?
I wouldn't say there's a market reason, except when markets start getting choppy, I forget to shave and I lose a little more sleep. So I think this is, I don't know if I call it laziness or just lack of time too, but lack of focus on the facial hair that's the first priority that goes to the side when markets start getting crazy. So it's not necessarily because steel prices are going up. Actually, steel prices are not going up right now, but yeah, that would be my main explanation. And then it's getting cold. Chicago gets cold in the wintertime, so you got to have a little buffer out there.
I hear you. Yeah. So if I heard right, you sacrifice personal care for the information.
Absolutely. Plus, right? I want to stop getting ID'd at the bar.
There you go. Well, this is great. Nick, as always, great information. As a reminder to the audience, the full recording will be available on YouTube tomorrow. We will also be sending the Metal Perspective survey right after this tomorrow morning. Please, if you get a chance, it's a quick, I believe, 6 questions. We'd love your input on that because Nick's going to be presenting that in February. And on that, this is the last time we'll be talking to you this year and collectively until February. So I wanted to wish everyone a happy holidays and thank you for making Cup of Joe what it is. And I will turn it over to Nick for some closing thoughts.
I couldn't have said it any better. Happy holidays, happy new year. We hope you like all the information that we've been providing over the last 9 sessions. If you've got ideas, tweaks you want us to make, we are all ears, but we're doing our best to give you the best information we can. We hope it's well received, and we look forward to carrying out the end of the year and building into 2022 with all of you. And thank you for joining us on all of these Cup of Joes. It's been great.
Thank you.